Good morning, everyone, and welcome to the DAX Open for Friday, the 10th of December. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM. I want to just highlight my email address at rshaw@fxcm.com. And again, anybody who needs to contact me, just shoot me an email to this address and I'll reply as soon as I'm able. Also, I guess just something I'm thinking of now, I know a lot of emails that I have sent, particularly I think it's Gmail, if I'm sending to Gmail, goes to spam. So if you think I haven't replied, just check your spam folder and see if it's there. And but nevertheless, this is the email to contact me. I'm just going to bring up a high risk investment warning. I'll keep this on screen for a few moments. Hey Jan, good morning, and very nice to have you on the webinar as always. And I'll take the opportunity to say good morning to everyone and appreciate everyone joining this morning. I'm just going to bring up the market commentaries disclaimer here as well. And let's just take a look at our references. So you know that we're going to use MarketScope 2 for the chart analysis, and we'll first start off with the CNBC European morning note, just to see what's in the headlines and anything we need to pay attention to. So the heading starts off: European stocks set for a slightly lower open as markets track Omicron and US data. And European markets are set for a tepid open on Friday as there's renewed concerns about the Omicron COVID-19 variant that continue to weigh while investors await key. Now this to me is the big one, key US inflation that's coming out at 1:30 p.m. GMT, so 3:30 ZA, 2:30 p.m. UK. We'll get this CPI and core CPI, and I think there is a risk building to the market around this, so we'll discuss this in a moment. The US Labor Department is set to release November's Consumer Price Index, and global markets will be closely watching the reading for indications on how the Federal Reserve may react. Estimates suggest inflation could have hit the highest year-over-year level since 1982, which is clearly astounding. What I think I'll do, it wasn't on our references. I just want to take a look at trading economics as well in a moment. I just think it would make a fascinating look. Just this since 1982's kind of got me thinking we should take a look at trading economics. Data on Thursday showed US jobless claims hitting the lowest level since 1969. So this is an astounding number. I did look at the CNBC article yesterday, and there is a seasonal adjustment here. So I think the headline or the unadjusted number is about 284,000, subject to correction, but nevertheless, last week was also seasonally adjusted, so it's still moving down. Okay, so the market, the labor market, continues to show signs of improvement, and I think that just as a comment there, for me, and I would expect for the general market, it's really now all about participation rate. It started ticking up, and we just want to see if that trend continues, especially in light of this new Omicron variant. Markets have been reacting throughout the past couple of weeks to comments and research into the transmissibility and severity of the new Omicron COVID variant, with a number of major economies now implementing tighter containment measures. US stock futures little changed in early pre-market trade on Friday after investors pulled back from the rebound earlier in the week. That's another key key theme I think we need to address. So the pullback, and I think this inflation number here, that's what we'll discuss in a moment. I've lost my place here. All right. Stocks in Asia Pacific broadly declined on Friday as investors opted for caution ahead of the data, while keeping an eye on news about the Omicron variant. On the data front in Europe, the Italian, British, and Spanish industrial production figures will be out today. In fact, I would expect some of these to already have been released. I don't have my calendar up here, but I think the UK is probably already out. Let me just double check that. All right, just while my calendar is coming up, German inflation figures for November are also due, and European investors may have an eye on speeches from ECB President Christine Lagarde and other top policymakers throughout the morning. And again, I guess this wasn't on my reference, and I think that I don't think my compliance department will be too impressed, but I just want to draw your attention to this is Forex Factory, okay, and we'll take a look at trading economics. These are kind of weren't really something I was planning on doing this morning, but I think we just need to definitely look at trading economics. Here's the UK construction and industrial production. Gee, that's a big miss actually to the downside. This over here is construction's an interesting sector in terms of economic series to keep an eye on, because it's all encompassing, right? Construction touches so many industries, and the fact that it's down, well, I would perhaps, just off the top of my mind, think perhaps COVID has something to do with that. That's a big miss. All right, and then here's the CPI, core CPI numbers over here. I just want to talk about CPI, core CPI. The market's expecting a big number here. If we go back, it could have been its highest year over year since 1982. So we're going to look at trading economics in a moment. I'll just click on this. Okay, so here's an article. We won't go through this article, but if anybody wants to, it's on CNBC, and let's go to trading economics here. I want to go through to the US. And I want to show you something here. I've got to give this some more thought, but just that 1982 is kind of really, it's just, it's kind of, I think there is some importance there that probably needs more investigation. Let's just go through to the interest rate. Okay, so we're talking 20 years back, right? So we can't click to 10, we can't even click 25 years. So we want to go max here. We want to go max here. All right, so just to kind of show you the difference in where we are in terms of 1980, the 80s, early 80s, and kind of where we are in the 2020s. Look where interest is in the 1980s. So if I'm understanding this, and again, as I say, it bears more thought. Investors brace for the highest inflation reading in nearly 40 years, but there's no interest in the markets. What a difference! Isn't that amazing? Just shows you the world certainly is different, just in terms of monetary economics, isn't it? So I guess I wanted to put that out there. Usually one would control inflation with interest rates. Well, gee, you know, we kind of still at the zero bound here, and that's telling us something. What is it telling us? I'm not certain. I think built into this 40 years would be demographics. I think built into this 40 years would be globalization. Built into this 40 years would be unconventional monetary policies, okay, which wouldn't have been, nobody would have touched them with a 10-foot barge pole in the early 80s, you know, sort of helicopter money, seriously. So there is a huge, sort of a huge change in economic philosophy between the 1980s and the 2020s. All right. Also now, just want to go back to this. So what does that mean for us? Okay, instead of kind of talking about sort of the theoretical differences in monetary policy, what's the big deal about inflation for us as traders today? And I think the big takeaway here, and sorry if I sound like a broken record, but it's caution, and I'm going to show you why now. So before we get into the DAX, which is what we all really waiting for, I did an analysis on gold this morning, and gold is actually getting pushed downwards at the moment. Where's my chart here? Okay, I want to go more to the lower time frame, so we'll go to the daily, and you can see that on the daily here. On the daily here, this is a reference candle. This is Wednesday, then a big confirmation of reference candle yesterday. So we've got some really big bearish action taking place here. In terms of the triple moving averages, you can see that the shorter is below the mid, and the mid is below the longer, and the longer is actually turning down. So there's just a lot of bearish pressure here. And if we go down to the hourly, let me just link this up. I must have changed it yesterday. If we go down to the, all right, so you can see that on the hourly we've got some triggers here, right? So in anticipation of the inflation, this high inflation in sort of 40 years, we're getting a pressure on gold, and that kind of seems counterintuitive. Like, isn't gold meant to be the ultimate hedge against inflation? And the answer to that, again, in my opinion, is it depends on this. Depends on this, because at zero interest rate, there's no real difference between, say, a bond as a safe haven and gold as a safe haven, assuming, of course, that you're going into, let's just say, a sort of a US Treasury, a British gilt, a German Bund. I mean, those are one would expect safe as houses, right? And of course, you want to go into the one that's giving the highest yield, okay, the highest interest rate. Now, if you're buying a bond to hold to maturity, you're not really too concerned about the price fluctuations. You bought it, you're just going to earn your interest, and you're happy with that. Okay, so you kind of now see that, well, wait a second, the chart, we can see that when inflation was so high 40 years ago, well, interest rates started shooting up. And, well, we're likely going to have higher interest rates here. Come on, I mean, might not be in the 80s, but something's got to give here. So if you're holding gold, you're actually incurring what we call an opportunity cost, because you're foregoing your interest payments if interest rates start rising. And I think that's what's putting this pressure on gold. I think that's what we're seeing here, this pressure on gold. Now, that brings me to my sort of point, which has been, I hope not too long-winded, but the idea here is, well, okay, we're expecting this big inflation number. Our question to you is, what happens if it misses? What happens if it misses? So I think the market has built a huge expectation into this number, and if it misses, I don't expect it to miss, but who knows, right? If it misses, I think there's going to be a huge squeeze. I think you'll see money fly out of the dollar. This, and again, it's just you know what I think. Nobody knows for sure, and I think you'll see the gold bounce, because it takes some pressure, I guess, off of the monetary policy, right? So there's a lot of risk, I think, baked into this release here. So if you're trading and holding over this time frame, just expect that volatility, because I think that the risk to a miss, the risk is skewed to a miss. So if we hit inflation, or if we beat the inflation forecast, I don't think that's going to have quite as big a market reaction than if we miss, because of the expectation, right? So I think that this is just something that you must know in terms of your trading, because if you're holding over this period, there is a risk built into this. So just be careful there, which of course brings us through to the DAX. We're going to go through that. Crypto is a bet against inflation. That's Jan's asking that question. Let me think about this carefully, Jan. I think that the crypto, off the top of my head, I've probably got to give this more thought. I think the crypto is very much in a similar situation to gold, in that interest rates, high interest rates, are net dollar positive, okay, which is exactly why if the yield misses here, you'll probably see money run out of the US dollar, go back into gold. I would suspect Bitcoin's in a similar boat there, in that you can see that it's under pressure now, and it's, you can probably apply the same argument. You see, I'm not sure whether Bitcoin's a safe haven. Bonds and gold, well, those are safe havens. Bitcoin is, let me actually say this, it's not a safe haven, okay? It's a highly risky instrument. In fact, I did an article on that earlier in the week, where we looked at these, number one, the standard deviation, then we looked at the beta. So it's a high risk instrument. So it's probably different to gold, but I think the fact that it's a ratio of Bitcoin priced in US dollars means that we probably at 1:30 GMT can apply a similar line of thinking. Does that help, Jan? I've probably got to think about it a bit more, but that's kind of off the top of my head. All right, let's go through to the DAX. All right, so I think the DAX here is in, it's kind of like a make or break day. And the reason that I think it's make or break day is because of our three conditions, right? So we've got condition 1, and we've got condition 2. Prices moved above this high here, but we've got nothing without condition 3, okay? And we are in a very precarious position. What's condition 3? Condition 3 is price closing above last week's high. So you can see that this is very precarious at the moment. If there's going to be any chance of a swing, okay, we must get these 3 conditions. Now, it doesn't mean that we won't get a swing going forward, but let's just say we don't get the 3rd condition. Well, I'm going to push this up next week and say to the bull, and think to myself, well, bulls, you've got to prove yourself to me. I'm actually raising the bar. So this is, I think, make or break time. It's also, let's just say we close where we are at the moment. It's also not, it's not the strongest close because it's well off its high. So if kind of we can get a bullish movement up today, that will go a long way, I think, in helping us in terms of understanding market price action next week. So this push down here is something I think we just need to watch very carefully. And of course, when we take a look at our zone analysis, well, we are still in zone 2, so we moved from zone 3 to zone 2. Here's the pullback that the CNBC article referenced. So we had this big jump early in the week, then we've had this big pullback. But if we take a look at it in terms of the daily here, let's see if we kind of get 1, 2, 2, 3. Here's the 2, 3. Now, and then, well, if this is a dip in the uptrend, then there's a potential opportunity here. Okay, if there's a potential opportunity here, let's see what the hourly chart is telling us. The hourly should give us some information, and you can see that on the hourly here, let's put in a. So we're about 38%. Got a 38% pullback, which is, you know, it's a pretty decent pullback from here. I don't mean to bring it up because I think that we're going to have a turnaround because it's hit a fib level. It's just, you know, we've wiped off, you know, more than a third of this leg's upswing. It's probably representing pretty good. It's probably presenting itself as a pretty good target for longs, given the fact that we may be at a swing low. Now, in order for that sort of to ring true, we need our EMAs to turn positive, and of course we need the stochastic to definitely move out of that 20 area. That 20 area is a disaster if it stays there. So we need to get it out of this 20 area, and of course we need to get it back up here. So there is a few things that we just got to confirm by the end of the day. Number one, where are we in terms of the weekly close? Because that's going to help us next week. And I think number two, is this a 2-3 correction? One last thing just before I sign out. So remember, this range candle here, I said, is potentially problematic because how are we going to make some sort of technical inference based on such a long range candle? Then last week's candle gave us a new low, which in retrospect, I think is a good thing. But this, if we didn't get that, this long range candle would have been problematic to find swing points. Well, that's exactly what's happening on the daily here. You've got this big long candle and then inside candle, inside candle, inside candle. I don't think that you can read these as bearish until we get below here. So that's why I think the path of least resistance is kind of this way. Okay. I think, right? And again, the inflation number might influence that somewhat. Just keep an eye on the triggers here, and of course, once the triggers are pulled, the real magic's going to happen if we get into the 80 level and hold. So that's what we'll keep an eye on. Hey Howard, there's not going to be another webinar today. I'm going to try for next week. We'll start doing some live trades next week, so apologies for that. All right, if there's any other questions, just go ahead, type those in. All right. Yeah, not a US Open, no US Open today. I haven't cancelled it as of yet. So if you get an invitation, then it's on. But at the moment, I'm not planning on doing it. But I haven't cancelled it on GoToWebinar just yet. All right, let's wrap up here, guys. Don't forget, if you need to email me, open invitation. Thanks very much.